Financial ratios are frequently used by managers to measure how efficiently a company funds are spent overall. Analysis frequently split program spending by overall expenses when evaluating the performance of a non-profit organization. Then there is increasing production. Once management has a better understanding of how its employees are functioning, it can focus on the areas that need to be improved. In addition, keep track of sales. Financial ratios are ideal for tracking any facet of a company's sales success. As published in the June 2011 issue of Construction Business Owner, comparing sales to the total labor expenses is a helpful ratio. One of the financial ratios that is most important is the quick ratio. This is one of the most frequently used types of financial ratio, giving a quick indicator of business liquidity. Then, debt to equity ratio. It looks at whether or not a business is borrowing more than it can reasonably pay back using equity as a metric. Moreover, working capital ratio, known as the current ratio, this looks at how well a company can pay its existing debts. However, it considers all current assets rather than simply liquid assets, so you do not need to subtract inventory from the equation. Next, price to earning ratio. It measures the amount an investor would pay for each dollar earned. This gives you a quick idea if a stock is under or overvalued. Furthermore, return on equity ratio. The result tells you about a company overall profitability and can also be referred to as return on net worth. Lastly, profit margin. This shows you how efficiently a company is managing its overall cost or how well it converts revenue into profit. Financial ratios are a common instrument used by managers to make decisions. A ratio is a mathematics problem that involves comparing one number to another. Financial ratios are calculated by comparing multiplied statistics from financial statements to acquire insight into a company performance. It is valuable tools for a business manager since they may be interpreted rather than calculated. Ratio can be utilized as indicators, clues, or red flags when it comes to significant correlation between factors used to assess a company profitability, asset usage, liquidity, debt, or market valuation. Also are used to compare present performance to historical performance. Financial ratios have some limits because they are reliant on accounting statistics in financial statements. Accounting figures, on the other hand, are prone to flaws, approximation, variation in practice, and even manipulation to some level. As a result, ratios are not very useful for making solid conclusions. Also, there is issue of comparability with ratio. Companies that are generally comparable may use various accounting methods, which can make it difficult to compare key linkage. Inflation may also limit the usefulness of accounting ratio. Historical cost-based financial statements and accounting data do not reflect current value figures due to inflation. Finally, accounting ratios are not completely reliable and must be used after giving due weightage to general economic conditions, industry, situation, position of firms within the industry, mode of operation, size of firm, diversity of product, which can make business enterprise completely dissimilar and thus affect the computation of accounting ratio.
The calculation of financial ratio. The first one is liquidity ratio. Firstly, we have current ratio. Having a ratio of 1.64 times means for every RM 1 ringgit of current liabilities, the company has 1.64 ringgit of current assets as backup as in 2019 compared with 2020, which is 2.50 times. The company has 2.50 ringgit of current assets as a backup. From the above illustration, Mareiki Berhad current ratio in 2019 is lower than 2020. Second is acid test ratio, which is known as quick ratio. Having a ratio of 0.93 times million for every RM1 of current liabilities. The company has 93% of current assets to cover its current liabilities without selling inventory as in 2019 compared with 2020, which is 1.23 times. The company has 1.23 ringgit of current assets to cover its current liabilities without selling inventory. From the above illustration, Mareiki Berhad asset test ratio in 2019 is lower than 2020. Efficiency ratio. We have inventory turnover ratio. Having 6 times of inventory turnover ratio in 2019 indicates that there is 6 times inventory is sold out and restocked in one fiscal period. 7.67 times of inventory turnover ratio in 2020 indicates that there is 7.67 times inventory is sold out and restocked in one fiscal period. From the above illustration, Mareiki Berhad inventory turnover ratio is greater in 2020 than 2019. Mareiki Berhad is more efficient. Then we have average collection period. In this case, Mareiki Berhad have 1,680 days refers that customer outstanding for 1,680 days in 2019 and 1,020 days refer that customer outstanding for 1,020 days in 2020. From the above illustration, Mareiki Berhad has the shorter average collection period in 2020, which is better than 2019. Furthermore, non-current assets turnover having 1.13 times of non-current asset turnover measure that Mareiki Berhad efficiency in utilizing its non-current assets is 2.81 in 2019 and 1.44 times of non-current asset turnover measure that Mareiki Berhad efficiency in utilizing its non-current assets is 1.44 in 2020. From the above illustration, Mareiki Berhad is utilizing its current assets more efficiently in 2019 than 2020. Also, total asset turnover having 1.13 times of total asset turnover in 2019 indicates that Mareiki Berhad is generating 1.13 times of sales with the given amount of assets and 1.46 times in 2020 indicates that Mareiki Berhad is generating 1.46 times of sales with the given amount of assets. From the above illustration, Mareiki Berhad is generating a higher value of sales with the given amount of assets in 2020 with 2019.
First, debt ratio. From the calculation, it shows that Mareiki Berhad owned approximately 57.15% in 2019 and 52.43% in 2020 of its assets are financed by debt, while the remainder are financed using shareholder equity. So, Mareiki Berhad has lower borrowing in 2020 than in 2019. Next is debt to equity ratio. From the illustration, Mareiki Berhad used more equity and lower borrowing as the source of financing in 2020 than in 2019 because having 135.29% of debt to equity ratio in 2019 means Mareiki Berhad have 135.29% of borrowing used compared with total equity in 2019 and 110.5% of debt to equity ratio in 2020 means Mareiki Berhad have 110.25% of borrowing used compared with total equity in 2020. Next is net interest earned. From the calculation, in 2019, Mareiki Berhad has 4.4 times of interest earned and 10 times in 2020. This shows that Mareiki Berhad has the higher ability to fulfill interest application in 2020 than in 2019. I will start with gross profit margin. From the illustration, Mareiki Berhad is more profitable in 2020 than in 2019 because a ratio of 20% means that company is making RM20 gross profit for every RM1 ringgit of sale made in 2019, and ratio of 23.33% means that the company is making 0.2333 sen gross profit for every RM 1 ringgit of sale made in 2020. Next is operating profit margin. Mareiki Berhad is making lower operating profits in 2019 than in 2020. A ratio of 9.78% means that the company is making RM 0.0978 sen earning before interest and tax for every RM 1 ringgit of sale made in 2020, and a ratio of 13.33% means that the company is making RM 0.1333 sen earning before interest and tax for every RM 1 ringgit of sale made in 2020. Next is net profit margin. For Mareiki Berhad, since the firm's leverage is lower in 2019 than 2020, its low net profit margin is basically due to the higher operating expenses. Next is return on asset. Mareiki Berhad return on asset is slightly higher in 2020 than in 2019. The fact that the net profit margin for Mareiki Berhad is lower in 2020 indicate that the higher return on asset is due to the efficiency of its asset utilization. The last one is return on equity. From the calculation, in 2020, Mareiki Berhad have better return for the shareholders than 2019 because it has a higher return on equity in 2020.
The evaluation of financial performance for the company shows that the company is getting better in 2020 rather than 2019. All calculations of the ratio show an increase from 2019 to 2020 in the liquidity, efficiency, leverage, and profitability ratios. From the view of Chairman Bank Finance Officer, the loan should be approved. First reason why the loan should be approved is because of their character. The company credit history shows it has good to excellent credit, which means likelihood that the company will repay a loan on time. Secondly, the capacity that measure the company ability to repay a loan by comparing income against recurring debts show that the company getting better in 2020 and can pay loan without problem. Third, the amount of capital the company put shows level of seriousness them in doing business, so it can decrease the chance of default. Next, the collateral that can help Mareiki Berhad to secure loans, so it will be less risky. Last but not least, the condition of Mareiki Berhad intends to use the money is for good purpose, so the money will be safe and